Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I will be your host for about the next 20 minutes here on Options Guide TV. Well, I'm going to look at the DraftKings trade that we put together, Open Wing Butterfly. We ended up making the official paper trade to the bull side of things. But if there ever was a sign or a feeling, I don't know how else to say it, but going with your gut, we did notice the huge implied volatility skew to the downside. There was a lot of put buying going on relative to the call buying. And I think it's an opportunity to talk a little bit about skew in that if you look at an option trading grid, all option prices aren't created equal. In other words, they don't come out of a theoretical world or a bucket that says this is the way these options have to trade. If you go to any course on derivatives and derivative pricing, it's always quite simple. You have implied volatility and you have these 5 different variables. You put them all together, you get a price. Well, when the real markets happen and people start trading with real money, money drives option prices on a more speculative basis in that if a lot of people are buying out of the money puts, you will see that those puts will increase in price independently of the stock price movement. So I don't know that it doesn't always set in with some people, but so even though the stock price does not move at all, you might see puts increase in value relative to their counterpart on the call side of the chain. So if I'm 10 points out of the money on the put, that can trade higher than being 10 points out of the money on the call. The at the monies are always usually fairly close. There are instances where models will break down. One of the things with a lot of brokerage firms is models will break down when you have an odd factor like a hard to borrow stock. They're not necessarily breaking down, they're giving you the deltas, the gammas but when you have a hard to borrow stock, that means that people have to pay money to get short the stock. That really looks weird on an option pricing chain. Okay. So when we went to draft, and I got to admit, I didn't have the best show on Wednesday. McDonald's actually ended up announcing later in the day, and McDonald's did really well. And I was thinking that, I got wrong information that McDonald's was going to be announcing before the open, but they did it after the close. And McDonald's did well. So that trade, if you realize that, worked very well at the end of the day. The DraftKings one is not. Right now, DraftKings is actually down $3.40. They had a very solid, a very, very solid earnings report. They also had the CEO of DraftKings came on and talked a lot about what they're doing in the prediction marketplace. So they're trying to compete in that marketplace. So I think I don't know if it's perceived that they won't be able to keep up with the brokerage firms and the exchanges, because there's going to be a lot of competition in that marketplace. The regulatory bodies haven't really caught up with all the rules that are going to be implemented with it. But when you start seeing exchanges getting into making markets, and then again, DraftKings, they're making markets over and over again. They're making books, right? You wouldn't call it a market, but they're setting lines for over and unders on football games. And, what are the odds of this player running for this many yards, that type of thing. I'm just thinking all about football. But record numbers of bets placed and the market on DraftKings is down. They have a huge spend. One of the biggest things is they do spend, we talk about an AI spend. DraftKings spends a ton of money on marketing. And but they're trying to get the people in the door, and they're trying to fight for this competition. The prediction marketplace is probably hurting them a little bit. I mean, that's the reason why I think they're down today. There's a perceived notion that they can't maybe keep up with some of the competitors that are in the space. But we looked at the option chain on Wednesday, saw the huge skew to the put side of things. I wanted to lean into the call side, but saw the skew. So we actually looked at a bearish butterfly that was open wing. So it would allow the stock to run to the downside, and that trade would have been good. The official paper trade that we put on was on the bull side of things, and that option, the trade is going to go out worthless. We did a 1-day trade because they announced on a Thursday, and you have the Friday expiration. So interesting, but it was just a real interesting lesson in option pricing. Sometimes you just got to go with your gut and what you're actually seeing in the marketplace. Now, you still don't know what the earnings report is going to be, right? So it's just like anything out there. It's a data point that you're just kind of one of those things that make you go, And I still remember talking about the meme stocks and talking to reporters about the meme stocks. And after the initial run up in a lot of the GameStop, which is the main one that really started everything, the skew in the option contracts basically said this isn't over. And a lot of people were like, look at all that money. It went all the way up. The stock is coming back down. But when you looked at the skew and the call side of things, and you looked at how much volume was being traded on the out of the money thing, I do remember having a call and saying, well, I understand that it looks like the market went up and now it's coming back down, but the options marketplace is saying that this isn't over with. And once again, it's just a data point. And the options marketplace was right. You look at the volumes, you see the open interest, you see that people are still paying up for way out of the money calls, and that's just a hint when you see those type of things. Another example of when that happened, and this was back during the financial crisis, and a lot of the car companies, there were a lot of money that was coming in on way out of the money puts, and talk about a skew of volatility, but they were in danger and they were struggling, and you were seeing the volumes come in, and they did in the market. The car companies, a lot of the puts that were being driven, or volume and implied volatilities, never actually came to fruition, but you saw the volume and you saw the volatility skew. And there's just times where it doesn't happen all the time, right? But there's times when you see volatility skew, and it gives you, well, it just tells you where the market is at and where all the monies are coming in. That simple. All right. So DraftKings, that trade didn't turn out. I'm looking at the site right now. Right now we have DraftKings, DKNG is the symbol. It's at 22. It's down $3 on the day. Inside the portfolio, we have the trade. We're looking at it going to 28. If we did the bear side trade, that would have worked. We didn't. We made the official paper trade this. And right now you see the midpoint on all the options is basically zero. There's nothing out there that's available. Now, on the Coca-Cola, the stock went down. And this was, we mentioned this on Wednesday, but let's pull up the Coke chart on KO, and DraftKings actually looks kind of, if I remember right, if we scroll out here, there's a big level of support right here. Well, let's show that, because this might be, in the short term, the chart does not look good in DraftKings. Now that we had the breakdown. Okay, let's go out 1,500 days, and I'll draw your attention to it if you weren't on the show on Wednesday. But you see right through here was a huge level of support, right around the 25 level. And even let's see if we can go 2,000 days here. And if you go all the way, even these are all the touches through here. And this was the downfall all the way back here. So it tried to come back to this range. And I'm stretching it, trying to make this a point of resistance to the upside after the drawdown. But definitely you can see through this range right here, head to head and shoulders pattern. And now, boom, we're dropping to the downside. So now coming all the way down to this point, yeah, we're right about there on the 21 range. If we break through that, I mean, the next stopping point is all the way down here, around the 10 range. So right now, the chart does not look good in DraftKings. All right, that simple. So if I was going to do anything, you're paying vol. There's a lot of vol still in those option contracts. Let's go back to the grid. Yeah, I mean, well, that's the near-term one. 78 vol going out 7 days. I mean, the volatilities are 70 vol. Well, that's not showing up here, but here we're seeing 70. Historical vol is 78. So the actual historical volatility has been more volatile than what the implied is at this point in time. So yeah, that's a tough one. If you're doing it, you're doing a long put spread. I guess that's how I would lean bearish with it. You could sell a call spread, sell an at the money call spread. That would probably be a fairly decent trade to do. Maybe 30 days out. Sell the 23. Buy the 25. That's not too bad. Let's look at that trade now that it's all said and done. I'm going to sell the 23. We're right at, let's sell the 22. So it's 2180. Sell the 22, buy the 25. Yeah, 3-point wide trade, and you're bringing in $1, and you're bearish on the trade. So this is a vertical spread. The thing has already happened. So if we stay below 22, we make $1 on this trade. The market's at 2180. Our break even is going to be at 23 right here. That's where we cross that. And then our risk is 2 points. So you're bringing in a third of the width of the spread. You're going out 28 days. If you believe what the chart is saying, it's going to be tough for it to get back. And now this is going to be a level of resistance right here to the upside, which is above the 25 level. Yeah, I don't mind that trade at all. 109, 2 points wide. And look at this. You're selling 65 vol and you're buying 63. That's 2 vol points. Let's look at the vol down here. So now look at over here on the put side of things. You can see things are out of whack, right? Volatility 74 or 64 on the at the money, and it's 68 there. You go a couple of points out of the money, you're at 74 on the implied volatility. You go a couple of points this direction, you're at 62. This is what I'm talking about. This is a ginormous implied volatility skew to the put side, looking at the March 28th expiration. I mean, they trade expensive as far as PEs and everything are concerned, but yeah, this is a 101 class on option pricing, looking at the DraftKings option prices at this point in time. Just interesting. I don't mind that trade right there. You got $1 risk, you got $1 for it to bounce back. You may wait a day. Maybe you put it on Monday. But the vol is there right now to do it. All right, let's make it a paper trade. Let's do it. Let's execute this trade. What we need to do to start, though, is we got to remove this DraftKings trade. That will just go away tomorrow. Well, we could try to close it. I don't know. We'll pay the 2 price. Okay, that should be fine. And that filled. And let's go into the options grid and let's put this trade back in. We're going to sell 21. So we're selling that. And we're buying the 25. Now we need it to be below 22. We're going to go 28 days. Okay, there we are. And rejected. Oh, let me close that. I froze things up. All right. That's going to be an official paper trade. Let's sell the 22 and buy the 25. Why did it reject this? Oh, as a credit. All right. I got that. That doesn't make sense. Didn't like the fact that I sent it to the floor as a credit. I'm just going to try to send the order to the floor, but I'm froze at this moment. There we go. All right. Short butterfly. And we'll pay the ask. Okay. Okay. And then we'll go back to the options grid. And we'll send our order to the floor and we'll keep this rolling. So we're going to hit this bid. 28 days out. We're going to hit that bid. And we're going to buy the 25. 26. Okay. $107. Net credit to the account. We'll have to go a little closer, mainly because, once again, it's a paper trading app. So I'm going to put it in at 104. If I'm trading, there's a lot of volume, a lot of things going on in the stock after the earnings announcement, I would try to trade it at 108. That's where I would start. And then I would give up a couple of pennies and I would work the order trying to get that order filled. But we have, and in the paper trading app, we want to get filled at 104. So let's hopefully get it somewhere between the mid price and the asking credit on that trade. All right. Other orders. Let's go back to our portfolio. Now, one thing we did well here in that our JP Morgan trade, JPM, the stock came off a little bit, and that kind of hurts our long call, but it's kind of looking like we are going to get a reprieve on our 330 strike call. We got, at this point in time, we got 28 days remaining to expiration. We sold it at $6.80. The midpoint now is $1.74. So if that goes down a little bit, we might just take this trade off and remain long our call option. But we did well, Pilgrim, right? Because we sold this for $6.80 and we can buy it back for $1.70. We still have a little bit of a loss, but our roll was very timely when we did that roll on that position. All right. What else do we want to look at? Okay, so next week, I don't want to put anything on today Next week we'll have some earnings trades, and we'll kind of look at them. One of the stocks that I wanted to add to the portfolio, though, there were a couple of good things that I saw here. Let's pull up this chart. BRKB. And we're going to look at adding something to our portfolio of stocks. And I don't know if it's a dot or not. Let's go take a peek at it. Well, here, let's add this stock. Let's add Berkshire, or I was looking for Berkshire, but let's look at IBKR, which is Interactive Brokers. And they are in the prediction markets, and they're doing quite well in that position. Wanted to add another financial. So let's go in this expiration, and we're going to go out to, let's go about half a year. We had we got February, March, June. Let's do the June. 125 days out, or else we got to go all the way out 217 days. I don't want to pay for that. We're going to look at the delta. The delta is right here, trading at 82 or 87. Open interest is 400. So this market's a little tighter. Let's do this one. There it is. Okay, so we're going to add this to our portfolio. We're going to add IBKR long, deep in the money call to our outperformer portfolio. 330 is going to be the asking price. And let's send that to ticket. All right. And here's our orders. My layout is this is the paper trading app, so I don't have the layouts that I normally have, but here we go. So here's our order. That's in it. This trade filled. So we're in, and where is our short spread? Right here. Let's see where we're at 104. We can bring that 115. So we should be getting filled. Well, 115 is the midpoint now. So 108 should have filled. Net credit for the day. I guess we'll put it in. I'd take $1 on this trade. 115 would be a good fill. Market must have moved a little bit on it. And we'll hit replace, and we'll send that in. So I guess this week, the only trade that we're going to have going into next week will be short the DNK call spread. Market got beat up today. Vol stayed high. When I see that opportunity on Vol, you might say to yourself, well, I want to lean bearish and I want to get bearish with a long put spread. But it's awesome if you can come in and actually sell an at the money call and get time decay and implied volatility on your side. So we're selling more time premium than we're buying, and get something where we have a solid ratio where we're getting a third of the premium versus the risk. We're paying $1 on a 3-point wide spread. So that's 1/3 of the premium. So that sets up well for a spread. Now you need the stock to cooperate in this situation. But the fact that the stock got beaten up, came all the way down, and we're able to put that spread on for $1 and lean into the bearishness in the DraftKings situation and the actual skew that goes along with it. And I don't mind that trade whatsoever. So we'll leave that there. And we added on the other side of things a competitor. Not who would ever think that this was going to be a competitor, but Interactive Brokers has always been a leader in financial markets, and they haven't always been the best marketing as far as a brokerage firm is concerned, but they've always offered very unique products and unique product offerings. So them coming into the prediction marketplace might have a little bit to do, honestly, with DraftKings getting beat up a little bit today. But they make markets and they know how to make markets. So making markets in the prediction space will be simple for them. And I do think that they're going to benefit from this wave that's going into this space in general. So we're going to get short DraftKings and we're going to get long Interactive Brokers, IBKR. That's it for this edition of Options Guy TV. We'll be back on Monday, and we'll set up and look at a few more trades. We're still at the end of earnings season, so we can still look at a few more fancy trades. We still got NVIDIA. To me, earnings season isn't over with until NVIDIA announces. That's they're the tail end of the Mag 7. So we still got a few more weeks left. We're going to have a lot of retail announcements coming up here soon, and we're going to learn a lot about the consumers. So tune back in on Monday, 11 a.m. Eastern Time, for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.